So I just want to thank everyone for coming. I will just get into some housekeeping here. So I would like this to be done in under 60 minutes. I appreciate everyone taking time out of their day away from family. So I'd like to be able to present this in under 60 minutes. There will be a Q&A after. So if you want to stick around and answer some questions, I'm more than happy to do so. First thing that I'll start is the good old disclaimer. So if I say something and it doesn't work out, just don't sue me. All right? Okay. I'm not a lawyer. I'm not an accountant. I do understand the basics, and I'm happy to refer you to an accountant or a lawyer that can help you if you have some questions. So a little about me before I do get into it is, I would say about 7-8 years ago, I didn't know anything when it came to finance. I was actually a tin basher or a sheet metal worker, as you can see here in the bottom right corner. But I also was, I took about a year off, went to fire college, and then I was a medic in the Army Reserves for about 7 years. And I was deployed for COVID-19. I was deployed for Operation Laser. And then in March of 2021, I was done my deployment. And at that time, it was time for me to move on. I did 7.5 years. And I found my passion with the financial industry, but not because I thought I would do this for a career. I was so unknowledgeable that I didn't even know that you can even have a financial advisor. So I got all the courses and I studied all the material, and I started realizing that there's a massive lack when it comes to financial literacy. And you can probably go down any street and you'll most likely find like a bank or a credit union, an insurance company, or an investment firm. So with so many financial products being sold, isn't it a little odd to know how little people know about finance? Because I was there. I'll be honest, I probably couldn't even spell TFSA at the time. So I just found my love for the financial industry, and I've just been pretty much totally obsessed. I incorporated in April of 2022. I started a different company for about 2 or 3 years, incorporated April 1st, 2022, and I've been off and running. When I'm not working, I do train Brazilian Jiu-Jitsu. We'll see if Jamie taps me out tonight if I pop in. So yes, I'm a purple belt under Tino Gazzardi. During the summer, I play a lot of golf, and I'm blessed to mention that I have won the 2020, the 2024, and 2025 Manitoba Mid-Amateur, and I've been able to be blessed enough to represent Team Manitoba on 4 Wellington Cup teams. And then on the lovely bottom left there, that is my beautiful fiance in the back, and we just had our first baby a couple months ago. So, okay, well, that's a little bit about me. My intention for today is just to give you a couple nuggets that you can take home and digest. I didn't know who was going to be walking through the door. I didn't know if I was going to be someone that was curious about starting a business, maybe someone that's 2 or 3 years in, they're just getting over that hump, and not really know how to set up their corporation or even the benefits of incorporating, all the way to the person that is maybe entering the succession plan and they have money in their corporation, they don't know what to do with it. So I want to tackle a little bit of both. There are some worksheets, and you can fill in the blanks as we go. That way when you can take it home, you can start to digest it in, because it is going to be a lot. Okay? So get into it here. So number one is, what are the benefits of getting incorporated? Put your hand up, because I'm curious if you were told that either by a family friend, a mentor, an accountant, that you shouldn't incorporate unless you make 150 grand a year, or in that ballpark. 1, 2, Three. Okay. So I was told this. I was told this early 2022. And one of the reasons why someone should consider being incorporated is, number one, you get liability protection. Okay? I have some contractors that flip houses, and they just started brand new. And when they said, well, my accountant said I should be making around 150 to incorporate, well, what happens if you hit the wrong wire? What happens if you're a landscaping company and you hit the wrong wire in the ground? You don't want them coming after your house. Okay, so if you have liability and you're worried about it, I don't know what it potentially costs you to get incorporated. What's around $1,500 to $2,000, depending on what lawyer you go to, and you get the liability off your back. So that's one. So that's why I wanted to get incorporated. Number two is something called the small business deduction. So yes, I'm sure that's why majority of us are here today. We want to learn how to pay less tax, right? Some nods? Beautiful. So we're going to talk about that. And number three that I don't think is talked about is, if you build a big business and you want to sell it one day, in 2025, the first $1.25 million is tax-free through a lifetime capital gains exemption. Okay? Now, the small business deduction. On your first $500,000 of profit, not revenue, this is profits. Okay? In Ontario, you will pay 12.2% tax. In Manitoba, you'll pay 9% tax. Okay? Now, you must be a Canadian-controlled private corporation, must not be a specific investment business, and your passive investment income must remain below $50,000. So that's a little bit on the technical side, but for those of you that are in the room that has a portfolio, or maybe you have some real estate inside of a corporation, you have to keep in mind that if you start going over $50,000 a year in passive income, for every dollar that you're over, the government's going to claw you back $5. So just think of it as extra taxation. Okay? Like I said, I would like to have this done in under the hour, but if you have questions regarding this, please feel free to let me know. Okay? A little more on the technical side. Now, as a sole proprietor, I'm just going to use the first income tax bracket for incorporated professionals. Okay? So yep.
Just before we move on, a lot of people might not know, including myself, what the passive investment money is.
Sorry?
The passive investment money?
Yeah.
What is that?
Yeah, like if you have a portfolio, right, and it's generating income.
So you got funds or stocks or stuff?
Correct.
And you gain more than $50,000 in returns?
In 1 year.
Profit?
Correct.
Oh, okay.
Or like rental properties, right? That stuff. Like passive income, right? Your portfolio, example, I'll just use round numbers. You have $1 million and you're invested this money and you make $60,000 passive income. You're 10,000 over the threshold, I'm going to claw you back 50 G's, right? It's 5 to 1. Okay. So I don't know if that's for anyone in this room, but I just like to let people know that, because if I do set up a portfolio in the corporation, I want people to be aware of it. Okay. That way, at least you're aware of it, and then I can, when we have reviews, it's like, hey, we're kind of getting close to that 50 G's. Maybe we should start looking at allocating some money elsewhere to start building wealth more tax efficient. Okay? But it's just the first 50,000. There were a lot of tax changes in 2017, and that was one of them, I do believe. Okay? So now, the first $500,000, again, 12.2% in Ontario, 9% in Manitoba. Because I do have some people that jumped on Zoom. Okay? If you're a sole proprietor, you are one entity. Yes, you might have a business, but you have to keep in mind that if you stay under sole proprietor, If you make $500,000, that's how much you're roughly giving to the CRA. Okay? And just let you know, I run into this quite a bit. Like, this is not, okay? That's why I want to teach this stuff. So, there are different ways that you can pay yourself. So, I don't know how many times that I've ran into a business owner where I've said, how are you paying yourself? And they're like, salary. Okay. And how did we come about that? How did you decide on whether you pay yourself salary? And the typical response is, my accountant just told me to do it. Okay. Okay. So I want to be able to teach you the pros and cons of salary and the pros and cons of dividends. And that way you're educated. So then you can go back to your accountant and talk to your accountant and see what's the best fit for you. Okay? Now, salary. You are going to create RRSP room. You are going to put money towards CPP, and the corporation will deduct it. Okay? Favor salary when you want RSP contributions. I'll be honest, this is my opinion. I don't believe a business owner should ever do RSPs. Well, that was a bold statement. Until they find out how an IPP works instead. Okay? Because once I teach business owners how an IPP works, I would say majority of the time we make the switch. Okay? Yes, in favor salary if you want to plan for an IPP, and I'll quickly teach that today. Okay? And if you like CPP, and we'll be talking about that as well. When would you want to favor dividends? People know what dividends are. It's just very simple term, it's just profits paid to shareholders. Okay? Since you're incorporated, you're a shareholder, you can pay yourself dividends, profits from your corporation. So paid from after-tax income, it's a slightly lower personal tax rate. You will pay slightly lower tax on that via dividends. And you are not contributing to RSPs or CPP. So I'm going to teach you what you're getting at a CPP, and then you can decide whether this is a good investment for you, because me and majority of my business owner clients, we reallocate that money elsewhere. Okay? Favor dividends when you're in a lower personal tax bracket. You want to minimize payroll remittances, and you're drawing off of passive income. Okay? Now, as a business owner, self-employed, you have to pay both sides of CPP. So if you're an employee, the max is roughly $4,500, $4,600. When you're a business owner or self-employed, you got to pay both sides. So it's roughly about $9,300 in 2026. Okay? Now, what is a holding company? Put up your hand if you've ever heard of like holding companies or holdcos. Couple, yeah. Okay, sweet. So what is it? A corporation that owns shares of another operating corporation, typically holding investments, real estate, or insurance. It's just a separate entity. Okay? What's the benefits? Asset protection. You can have investment planning. You can structure a stock portfolio in there like myself. You can put permanent life insurance instead of a corporation. Instead of paying for life insurance personally, you can structure it in your corporation. That way you're paying it with, in Ontario, 12% after-tax dollars, not potentially 30 or 40% after-tax dollars. Okay? Succession and estate planning. So simplifies reorganization for the lifetime capital gains exemption strategy. Okay? Setting up your corporation to be the most tax efficient on the way out. Holdcos can receive dividends tax-free from the operating company. That is true. So A&E is my operating company. Okay? Once I pay my taxes, and if I do have a good year, I take profits from my operating company and I just e-transfer it to my holding company, and I'm building wealth in there. I pay myself just enough to live, and I'm building wealth in my holdco. Okay? Now, when you make that transaction, you e-transfer money from your operating to your holding company, you will not pay taxes on that transaction. So now you can have your money protected while also building wealth and there at a lower tax rate. Okay? It's called an intercorporate dividend. Easy way to think about holdcos. Essentially just like that. You have your operating company. You don't have to open it. I waited a couple of years before I went back and opened up a holdco. Okay. But if you're worried about customers, if you're worried about suppliers, if you're worried about potentially an employee pulling a fast one on you, you don't want to be building wealth inside of an operating company because it's open for creditors. Okay. So if you want to protect yourself again with liability, you can build wealth somewhere else. Okay. And again, keep in mind of the small business grind down. Okay. Hopefully I'm not going too quick. Is that good? Am I going too quick or should I slow it down a bit? Slow it, yeah. Good.
We want to pay attention.
Okay, perfect. I'll slow her down. When a holdco makes sense, you want to retain and invest income outside of the company. You plan to hold real estate or corporately owned life insurance. You're concerned about creditor exposure. Okay? And you're considering estate or succession planning. Okay? That is when you should consider if a holding company makes sense. Okay? I'm not talking about both sides. What are the downfalls of being incorporating or incorporating a business? There's additional costs. Accounting fees, there's legal fees, right? So just be aware of that. When I help someone get incorporated, the amount of money that they're spending in tax, we just use a portion of that money to get them incorporated and pay for the accounting and the legal fees. And they're still surplusing majority of the time. Okay? Now, this is probably an overlooked, from what I've seen. What is a shareholders agreement? So if you're in business with someone else, right, you can structure something called a shareholders agreement through a lawyer. I recommend doing this when you're in the honeymoon phase, when building your business. It all looks all sunshine and rainbows, right? You're all excited, you're all pumped up to build a business together. And what it does is it's going to have a bunch of triggering clauses in there. It's going to identify what's going to happen with the shares if someone passes away or becomes disabled. If I'm in business with somebody and they were to pass away, what happens to their shares? Does anyone know?
Depends what you have written down.
Spouse.
Bingo. The spouse. Okay. So the question is, do I want to be in business with my business partner's spouse? And he or she has probably never ran the business and don't know what it's like, right? And it's on a disability as well. Do you want to keep paying out your business owner and they're totally disabled, they can't move, right? Retirement or a voluntary exit from the business, divorce or bankruptcy, or shareholder disputes. You eventually aren't getting along anymore, and how are you going to figure out ways of settling this? Okay, I would say the biggest one is I recommend is just peace of mind. And a story that stands out to me is there's an auto body shop, mechanic shop in Winnipeg, and my dad's buddy had a handshake agreement with his business partner that the corporation was going to pay for a life insurance policy, and if anything were to happen, it's a handshake agreement that, you know, he would take this and they would just give it to the wife because he wanted to pay the lower tax rate. My dad's buddy passes away in a snowmobile accident. And what does the business partner do? Pocketed it, right? With obviously a wife at home and 2 girls, and they were like 7 and 5 at the time. Okay, so since I've been in this business for roughly 7-8 years, I see this stuff all the time. So when I have young up and coming entrepreneurs, I always just do yourself a favor and just talk to the lawyer about getting a shareholders agreement in place. And then that way, I'm not sure how much it costs. I think it's roughly $1,500, $2,000, and then just tuck it away and then act like you've never seen it, just to protect yourself. Methods of funding a buy-sell. So now, okay, my business partner passes away, and now the spouse owns the shares. How am I going to buy her out? Right? You can do it from retained earnings. You can go get a loan through the bank, or you can just simply put a life insurance policy on the corporation. And then the shareholders agreement will mention in there, life insurance policy gets paid to the corporation. I then take that check, I buy out the spouse, and now I'm 100% shareholder, and she's happy because she got her lump sum tax-free payment. And now it's all wiped out. Okay? So I wanted to make sure that I mentioned that because that's typically missed. Capital dividend account. What is it? If you go to your accountant and you start talking CDA, they're going to love that. Accountants love the capital dividend account. So what is it? It's a notional account that tracks amounts that can be distributed tax-free to shareholders of a Canadian-controlled private corporation. Right? It's ways of getting money out of the corp without paying taxes. That's what it is. It's not reported on the balance sheet, but is critical for effective tax planning. And unfortunately, this has been missed. And business owners will pay hundreds of thousands of additional taxes that they didn't need to. Okay? So, what credits the CDA? Because it is a credit. Okay? Non-taxable portion of the capital gain. I'll give you an example. You have easy numbers. You have $500,000 in a portfolio. It grows to $1 million, and you sell it. The gain is $500,000. You pay taxes on $250,000, and the other $250,000 flows through the CDA to yourself personally, tax-free. Okay. Now, capital gains tax is one of the most efficient taxes you'll pay. Okay. So if you have questions on that, please feel free to let me know later. Okay. So it's the non-taxable portion of the capital gain. Okay. Capital dividends received from other corporations. Okay. You invest in a stock that pays out dividends, specifically Canadian eligible dividends. You can flow it through tax efficiently. So it's not only just investing in whatever you want kind of thing. Let's set up the portfolio inside the corp to be tax efficient. Okay. Life insurance proceeds received by the corporation upon the death of the insured minus the adjusted cost basis. So, big one for farmers. Farmers have a corporation. They want to be able to pass it tax-free to the next generation. How are they going to do that? Right? Because they know they can't pay the tax bill upon death. A lot of people will structure a permanent life insurance policy that gets credited to the CDA. Okay, minus the adjusted cost basis, and then now they can use this money to pay for the capital gains. Because yes, unfortunately, the government does tax you upon death as well. They tax you when you make it, they tax you when you spend it, they tax you when you invest it, and they tax you when you die too. Okay? So that's more on the estate planning. Once a credit exists in the capital dividend account, a corporation can elect to pay a capital dividend to shareholders, and the dividend is tax-free to the recipient. Okay? So, in a nutshell, the capital dividend account is an excellent tool that you should be aware of and you can take advantage of later to make sure your corporation is structured tax efficiently. Okay? Now, 2 mistakes that I see business owners make all the time. Number 1, they don't put away money to pay their taxes. Right? That's a big one. And number 2, they don't invest in a strong disability plan. Right? Because they just always thought that, hey, I have it through my work. And then when you go on your own, you don't have anything. And you never really think about getting something. Right? So imagine this is your income trajectory from basically 30 to 65. Okay? Roughly making about 100 grand a year. If you were to slowly give yourself a pay increase of 2%, 2 to 3% roughly, from 32 to 65, you would bring home about $5 million. Okay? Now, if you were to go to RBC Insurance, what is the average claim? What is the age of an average claim for disability, you think? Any guesses? You don't say anything. Right?
42.
It's 50. Okay? So the average age of a disability is 50, and the average claim is roughly 4 years. So for the young bucks in the room, I understand that you probably think you're invincible and nothing's going to happen to you. I get it. I'm the same way, right? Except if I roll with your husband, right? So it's about locking in the rate now, and then that way, when you're in your 50s, you're still paying the rate that you paid like 20, 25 years ago. And you can see how much income protection that you can have. So what happens if a disability ends your ability to work entirely? Now you can see that's an income loss of about 2.8 million bucks. Okay? And yes, being in the for 4 years, you would lose $618,000. Okay? Now, the common thinking is your house is the biggest asset you have. I ask Canadians all the time, what's your largest financial asset? They tell me their house. Okay. As an example, let's say we were to grab someone's assets. They have a house, they have a boat, they have a truck, 4-wheeler, and a car, right? And we were to consolidate all these assets together, okay, when in fact is your ability to generate an income. So when you compare all the assets compared to your income, your largest financial asset is your ability to work your 9 to 5. It's not your house. Okay? Now, there are, for people in the room that have employees and you're doing well in your business and you have some profits and you want to give back to your guys and your gals and give them disability insurance, you can set it up where the corporation pays for it. You create loyalness within your employees and the corporation will write it off. So I've seen a lot of disability plans where they weren't structured properly. The employees were paying personally for their disability. Right? Maybe it was a shared ownership. Maybe it was like the employers covering some and the employees covering the other. Okay? So the book at the back is called the Wage Loss Replacement Plan. I have a little booklet on it. It's all backed up by the government with some examples. So you can provide all your employees disability insurance and the corporation will write off those dollars. Okay? There also is one back there called the Executive Health Plan, where it's critical illness. You put critical illness on inside of a corporation. If there is a diagnosis, a check goes tax-free to the corp. Pays for your employees, pays for rent, pays for all of your fixed expenses, and if you don't get diagnosed in 15 years, the money that you've put into this policy, you can get out tax-free to you personally. So it's ways of getting money out of the corp tax efficiently. Obviously, you're hoping that you don't get diagnosed. It's more of a tax planning concept. But if you do get diagnosed, it's tax-free money to the corporation. Now, your ideal employee. I call this put me on your payroll. Okay? So I'm going to work for you for $10 an hour. Okay? After 10 years, you can fire me, and I'll give you back everything that you've paid me. After 20 years, you can stop paying me, and I will continue to work for you for the rest of your life. When you retire, I'll pay you an income. If you need to borrow money, I will either lend it to you or co-sign it for up to 90% of the wages that you've paid me. If you become disabled, don't worry about it. I'll pay for myself. When you die, I'll make a tax-free lump sum payment to your family or your business. Anyone want to guess what this is?
Disability covers.
It's permanent life insurance. Okay. So I have business owners where they make a lump sum into a permanent life insurance policy and then they immediately borrow it. And they go buy their tractors and their trailers and their excavators. And then the interest, because you're going to a third-party lender, the interest is tax deductible to the corp. Okay? So permanent life insurance is not just there for succession planning, it's also there for business owners to invest back into their business tax efficiently. Okay? Again, there's a workbook back there. It's called Permanent Life Insurance for Business Owners. We can talk about that concept. Okay? Now, 5 business owner must-dos. You gotta pay your taxes. We can't evade taxes, but we can certainly find ways of minimizing it. Okay? So we gotta make sure we set money aside, because if you're an employee, you get your paycheck, your taxes are immediately taken off, and then you spend what's rest. But when you're a business owner, you get paid, you spend your money, and then you pay your taxes on what's left. So it's a little bit different. Okay, so we have to make sure we set money aside to pay our taxes. You need to have employees to have a good, strong business, and that's when eventually we can start setting up a pension plan, maybe RSP matching program, and group benefits. Okay? When one of your employees gets sick or disabled, who's the first phone call they make?
Boss.
It's the boss, right? It's the first one they usually make. There's key person insurance, okay? So I'll typically ask somebody, hey, when you took 6 months off your business, who was the person that was opening up your doors, or opening up the doors for your customers? And they usually reply with 6 months. I didn't take 6 days off my business. Right? What happens if you have a stroke? What happens if you got disabled? Who's going to be the person opening up the doors? Oh, that's Joe. Okay, that's your key person. Okay? So you can put like a $50 a month. It can be quite affordable, and that way, if this person goes down or passes away, you are able to get a tax-free payment to the corp to then hire someone and train them and hire that off. So if you have someone that's a supervisor of a business and you really need this person, and if you lost them, there would be substantial losses to the business. That's your key person. Okay, and you can insure them, so that way, in case something happens, the business can operate still. Okay. Now, we have to make sure we keep the banks happy. Okay? Now, when it's sunny, the banks will give you umbrellas. Okay? However, when it rains, they're going to take those things away immediately. Okay? The bank is not your friend. The bank is your friend if you have cash. Okay? And they might be really nice people at the bank. Might be really nice people. But as soon as the bank's in trouble, then you're in trouble. Okay? I see it all the time. And then, usually a business owner tries to get all of their profits down to zero. So once someone's in a position where they're trying to minimize that and try and get it down to zero, okay, I need to teach people what an IPP is. I'll do it a little bit later on in this presentation. I want everyone to be aware of it because I don't want someone from this room or a client of mine to then go to see someone else and then this person says, oh, I'll never tell you how an IPP works, and then all my credibility's gone. It happens, right? So I'm going to teach you the basics of how an IPP works and when you should kind of fit the bill to have one. Okay. Now, retirement planning for the business owner. Business owners must proactively build retirement security. Income in retirement often comes from RSPs, TFSAs. There's non-registered investments, corporate retained earnings, the business sale proceeds, right? The lifetime capital gains exemption. There's insurance strategies, and there's the IPP. So let's talk about an RSP. You're paying yourself a salary. So a lot of accountants will say, oh, pay yourself up to the 177 range, and then max out your RSP because you'll drop a bracket. Put the 36,000 in your RSP, right? Okay? So you're going to pay yourself more money, kids, right? You're going to pay yourself more money to pay more in taxes to put inside of a vehicle that is taxed, and then if you pass away without a spouse or you pass away in the same year, the government's taking half of it. And if you look at the history, are taxes going up or down? No comment. Beautiful. So, as a business owner, I'm not a fan of RSPs. I'm not a big fan of them. Okay? Sometimes they work, right? But majority of business owners, educate yourself on how an IPP works first, and then we can talk RSPs. There's also the tax-free savings account, which I think is one of the most underutilized tools. This is not a savings account. I think you should call it tax-free retirement account, right? Most of the banks, they put the portfolio in cash. So it's no different than like your checkings accounts. You're really not getting much in there, okay? This is a legit investment vehicle that you can use to supplement your retirement tax-free. Okay? So for surplus cash, tax-free growth, and flexible access. So again, if you were to pass away, it is going to go tax-free to your beneficiaries. Okay? And then there's the IPP. Okay? This is a defined benefit pension plan. Okay? It is predictable retirement income, especially for owners over the age of 40 with stable earnings. So with an IPP, you can put way more in there than an RSP. So I think the max is like 36,000 something for an RSP. You can put a lot more than that into an IPP. The reason why they use 40 is because the actuaries are basing it on your age and your income. Okay? The older that you are, the more you make, the more you qualify for. Okay? And what you're going to do is you're going to use corporation dollars instead of personal dollars, like an RSP, and the corporation writes it off. Okay, I want to say it one more time. It's super important. It is a defined benefit pension plan, which is like the gold standard when it comes to pension plans. You have to pay yourself a salary. Okay? You gotta be paying yourself a salary. Over the age of 40, predictable income. And you can put a lot more than RSP. It's used with corporate dollars instead of personal dollars, and the corporation writes it off. So it's really finding ways of the business owner to get down to paying the least amount of tax, obviously. Okay. Retirement planning for business owners. What to know about CPP and OAS. Now, When you're on a salary, again, you have to keep in mind you got to pay both sides. You got to pay the employee side and the employer side. Okay. If you earn $74,600 annually, you will max out CPP 1. If you earn $85,000, you will max out both CPP 1 and there's now a CPP 2. So you're going to pay an additional like another, I don't know, $800 in tax on CPP. So those contributions total, okay, yes, about $9,300 total. Okay, so you have a spouse. Let's say you guys are both paying yourself $100,000 a year. He or she's roughly putting around $4,500 a year for CPP because he or she's an employee. You're paying yourself the same. You got to pay yourself about $9,300. And when you're 65, you'll both have the same amount. So you're paying double, right? Okay. Now CPP in a nutshell. Can't access until age 60. Recommended you take it at 65 or potentially even 70. CPP is taxed at your marginal tax rate, which means your highest. By the way, CPP and OAS, Canada Pension Plan, Old Age Security. Okay, these are supplementation programs that the government will give you to help out you for your retirement. Okay? Because it is taxed as income, there is potential for OAS clawback. So if you want to have a really nice, strong retirement because you've worked your butt off all these years, and you are over, I'm not sure what it is for 2026, but 2025 was roughly $91,000 of net income. For every dollar over, the government's going to claw you back 15 cents. So just think of a double tax. Okay? So there's OAS clawback, and CPP has a $2,500 death benefit. That is taxable. It's not net. Okay? So, that is taxable. So what do I do? Okay, so here's how I think of it. I'm going to pay $9,300 in CPP if I pay myself more than $85,000 a year. Okay? I pay myself in a dividend. I take the money that I would have given CPP, and you can invest it on your own. And again, if history is any indication of the future, you're most likely going to have way more money for your retirement. Okay? If you look at what the government's budget is compared to how much they're spending, there are actuaries saying that, I mean, in 30 years there'll be something, but the actuaries are saying that, you know, when my son is like 65, it's going to be in jeopardy. Okay? So I keep my $9,300 and I build wealth in my holding company. You're either going to give it to the government or you can give it back to yourself. So for business owners that are more on the disciplined, you're really organized, right? They usually tend to do dividends and they reinvest it themselves because they're not going to touch it. Some business owners, disorganized, they don't do their taxes, their business is a complete mess, honestly. And it's probably better off to do a salary because at least you have something. So when I'm doing planning, I have to have a deeper understanding of who this person is. Okay? So what I do is I take the $9,300 that I would have given to the government and I jam it inside of a permanent life insurance policy. Why do I do that? I can access the policy for cash whenever I want, not age 60. Life insurance is tax efficient. I can take tax-free loans in retirement, okay, and evade and not pay taxes on that. I'm not open for OAS clawback because I'm structuring it tax efficient. And if I were to pass away, let's just say that Emily has to act upset at the funeral. Okay, it would be a tax-free payout of like north of $1 million. Okay. Now, OAS. So you look at old age security. I did my EPC designation about 6 months ago. So it stands for Elderly Planning Counselor, and they really did a good job of summing up each benefit. So old age security is the largest expenditure the government is paying right now. 81 billion, and that's increased by 40% in the last 5 years. And by 2043, 25% of Canadians are going to be 65 plus. And you think our healthcare is bad now. Okay. So, now, as you can see, there's been some conversations about delaying OAS from 65 to 67, right? That was under the Harper government, Harper administration. So the moral of CPP and OAS is just, I tell people, is just educate yourself and then choose what's in the best interest for you. Okay? I don't know one business owner that wants to pay $1 more in tax. Okay? So these are some strategies that you can apply to yourself. Okay? And the thing is too, I always mention as well, is if you look at our healthcare right now, and I see a lot of people that don't have any disability insurance or critical illness or life insurance, right? Okay. So if you're going to take one thing from this, is make sure you invest in a strong disability plan. Okay. I can tell you hundreds of thousands of stories. I'm not going to do it today. But since I've been in this for 6 or 7 years, I do see it all the time. Okay. Talk about business owners now for investing. Put your hand up if you've ever heard of something called a separately managed account, an SMA. Okay. So a separately managed account is a professionally managed investment portfolio for a single investor, like a holding company. Okay. Tailored to the corporation's specific needs, risk tolerance, and investment horizon. Transparency to all of your holdings, and with individualized tax management strategies. Okay. Why is it worth looking into? You have to keep in mind any interest, any fixed income, any bonds. That's taxed at 50.17% in Ontario. It's 50.67 in Manitoba for the people that are attending on Zoom. Okay. So that's why you can set up a portfolio, because with a mutual fund, you don't know what you have. So if you go to the bank, all you can see is your top 10 holdings. That's it. Okay. Where with the separately managed account, maybe the professional money manager is going to put you in like 30 stocks that are growth stocks, because that's more tax efficient. You want to pay capital gains, or you want to pay 50%. Okay. So the fixed income part of my portfolio is held inside permanent life insurance. Why? Because I get a 6.4% dividend pretty much every single year, and I don't pay taxes. So it's not about how much you make. Sometimes it's all about what do you keep. What do you keep inside your pocket? Right? Sure, 10% sounds great, but you're netting 5 in your pocket after taxes. Why don't we try and get 7 and we net 7? Right? Okay. Now, as an example, an employee earning 150 grand a year. So this is what I see quite often, so I want to provide an example. This is as maybe a sole proprietor. They make 150. Okay, 50,000 has to go to the CRA. They're living on 71 grand a year, so they can allocate the rest towards their investments. Okay? Now, what if they had a corporation? And they could still live on that 71,000. Maybe we set up like this. You pay yourself 100,000 a year, which would be this in this example, this is salary. Okay? You're going to see that since you pay yourself 100,000 in salary, $29,000 is going to the CRA. Where 50 is going in here. Okay? You're still going to live on $71,000 like you were, but that extra $50,000, we can keep that in the corp. Why would we keep it in the corp? Well, because this is in a Manitoba example, you're only going to pay 9%. In Ontario, you'd pay 12%, 12.2. So you can see how much more you can put inside of your investments. Okay, so you're not evading tax, you're just minimizing them and deferring it for later. Okay, so you can build your wealth on lower tax dollars. Now, structuring a corporation. You have $500,000 of profit. So you can see that $61,000 is taxed in Ontario, or $45,000 is taxed in Manitoba. And then you can pay your kids a salary, pay the spouse's salary, and then you can choose how much you need to live. So that's one question that I'll ask business owner clients. How much do you need to live? And they usually don't know. Okay, so I have an Excel spreadsheet that business owners can fill out, and then they know, okay, I should be roughly paying myself $5, $6, $7, $8 a month. And then you can deem whether, hey, do I like salary or do I like dividends? That's why I wanted to create the worksheet, because like I said, it is a lot of information. Okay. And then, okay, from your personal bank account, you can have your life insurance, your critical illness, your disability protection. We can set up tax-free savings accounts. If you're saving for a house, we can do a first home savings account. Right? There's RSPs you can do. And then the remaining $395,000 in cash, you can always just reinvest it back in the business. Right? That's why the government will give us lower tax incentives, so we can reinvest that money back into the business, have a bigger, stronger business to eventually hire employees, pay them salary, which means more money to the government. Right? So they have to create tax incentives for the business owner. You can also do that intercorporate dividend, which is tax-free. Your accountant would do that. And you can build wealth inside of a holding company. You can have a stock portfolio in there. You can have rental property in there. If you're family focused, you want to set up your kids or your grandkids, you can structure permanent life insurance policies in there. And then one day, maybe someone's going to try and offer you and buy your business, right? Well, if you structure it up properly, again, the first $1.25 million is tax-free. Anything north of that, you would pay capital gains. Okay? So then you would not pay taxes on the first $1.25 million in 2025. And then there's all kinds of more tax strategies. Talk to a lawyer, but you can double it up with your spouse. If you have a family trust, you can put your kids in there. You can keep multiplying it. Okay? But that's for an accountant and a lawyer. That's way above my pay grade. Okay? Or if you think that Ottawa can spend your money better, then we can just do this. Right? Right? So there's also this strategy. Now, farm succession planning. Touch on farms quick. So family farms make up nearly 75% of all farms in Canada, operating as sole proprietorships and partnerships. 23% of farms operate as corporations, mostly family ran. Only 1 in 12 farms operations have a formal succession plan. So do you know if your family members want to continue the farm? Do they know your succession plan? Is your plan in writing with an anticipated timeline? Do you know the value of the farm or the business? Can it financially support all family members who want to farm? Right? What happens if you have 4 kids, one wants to take over the farm, 3 don't? Right? What do you do in that situation? Do you know how much future income you need to retire? Do you know whether you live on or off the farm? Have you considered other tax impacts, financial and legal options for transition? There's something called like a rollover. Well, essentially you're doing is you're just rolling on the tax burden to like your kids and your grandkids. It's not really recommended, but if you don't want to pay the tax bill, you can just pass it down to your kids if you want. You could do that. Okay. Eventually someone's going to pay the tax, so. Have you thought about the transfer of labor versus the transfer of management and who does what? Do your plans consider family members interested in farming and those who aren't, which is the big one with farmers? That's the biggest hurdle. Do you have a team that can support you? Banker, an accountant, a lawyer, a tax advisor, a financial planner. And if you want, RBC has a really good article on this. So feel free to take a picture, take a screenshot, because they have a really, really good article on this. Now, look at that, we're almost done. So, leaving a legacy. Your business will change hands. Okay. Now, again, 50% of Canadians have a will. Take it back. Everybody has a will. Is the will under what you want to do or under what the government wants to do? Because everyone has a will at the end of the day, right? It just depends if you want to get the government involved. So do you have a will? Do you have a power of attorney? Do you have a healthcare directive? I have reviewed and created a shareholders agreement if I'm in business with somebody else. The business is structured tax efficiently for the future, and I would know what to do if someone came in ready to buy it. I've protected my income and the business against the risk of disability and a critical illness. I have a buy-sell agreement in place for death or disability. I have evaluated a holding company to protect retained earnings. I have evaluated corporate-owned life insurance as part of my estate or retirement planning. I have built a succession plan or a legacy plan and have communicated that to my family. And I have evaluated charitable giving as part of my legacy planning. Okay? So, look at that. Finished in 58 minutes. Told you I'd be under the hour. Right? So, I know that was a lot. I know it was. Okay? That's why I wanted to create the workbooks. That way you get to take it home, see what you like, see what's practical for yourself, what's not so practical, but you can always go back to this in the future. Okay? Now, I do have some cue cards there. Okay? I enjoy doing this. I don't know if much of this stuff is talked about in Fort Francis, so I'm more than happy to come back in a couple of years and do another one. I was hoping to bring my accountant and my lawyer down, but stuff popped up. I wasn't able to bring them. But I guess we have some time for Q&A if people have questions. Yes?
You touched on the Key-Man insurance. With
Yeah.
a lot of us being small business owners and our staffing kind of always evolving and changing, how easy is that to like either transfer or is it a whole new policy?
Okay, are you talking about the transfer of ownership from personal to the corp? Or are you talking about just like getting a policy?
Like for the golden handcuffs.
Yeah, the golden handcuff.
Okay, so sorry, say your question one more time so I make sure I
Okay,
understand.
so like say I have a small business
Yeah.
and I have a key supervisor.
Yeah.
And I'm having a hard time keeping staff, and next year it's a different supervisor and another one. So is it an independent policy each new person?
Correct.
Oh.
Yeah, because this person has to go to underwriting, right? Because they have to fill out a paramedical. They got to do potentially blood, potentially urine. So you're insuring this specific individual. So yes, it would be, and like to qualify for key person insurance, like you got to be able to prove to the insurance company why this person's a key person. You can't just insure everybody, right? And then they'll decide, okay, yeah, this person's a key person. Really good question. Good
What
question.
happens if you and the key person go down at the same time?
Ooh. Okay. Okay. Is there a policy? Is the corporation paying for a policy?
Like, if they were both covered, is there gonna be any kind of like questions or stipulations with that?
Okay, so there are stipulations, like number one, was there fraud committed on the application?
Like
That's-
if you were both in a serious accident together or something?
Yeah, I mean, if you did not commit fraud on the application, you obviously paid the premiums for life insurance if you didn't commit suicide in the first 2 years. Okay, so as long as you don't do these, okay, then
She's like,
I travel a lot.
okay, it's for compliance. I have to say it. It's for compliance. Okay. Okay. Yeah, like if they're investing in a disability policy, then this policy would go to, well, it depends how it's set up, but it would eventually like I also have disability on A&E. So what happens is if I go down and I can't work, then the office rent, I get a monthly payout to my operating company. I can pay for my employees, pay for the rent, pay for all my subscriptions, and the corporation writes it off. Okay, so that's not in the booklet, but it's called business overhead expense. Okay, so I have disability personally. If I get in a car accident, I have money to pay my bills personally. Then a policy will also go to A&E, so I can still keep my employees working.
What was that called again?
It's called business overhead expense. And the corporation writes off those premiums. So it's corporation paid, and the corporation will write off those dollars. Okay? Good questions. Isaac.
hey, you were talking about getting around paying CPP, right?
Yeah,
I thought you have to pay CPP. Not.
I hear that a lot.
So why do big corporations pay it?
Sorry?
So why do big corporations pay it then?
Well, because they
There's
probably
a better
need
way of
them,
doing it.
or because they probably need a massive write-off.
No.
Right? So like in that situation, it's just like if you're a large corporation and you need the write-offs, those are good problems to have. But for small business, right, if you're just climbing the ranks, right, is like me, myself personally, maybe I'll switch it up later in life. If I need more tax write-offs, you can always do both. You do salary and dividends. It's just educating you on both, and then you can decide what's in the best interest for you, your family, and your business. Nothing. I'm not anti-salary or anything. I think they're both great. I think that you just got to learn which one's best for you. Okay. Hopefully that answers your question.
Sure.
Well, if it didn't, I mean, feel free.
Don't remit. They'll come
Yeah.
after you.
Yeah, along the same lines of the CPP, so
Yep.
what you're suggesting is I'm incorporated, but I pay myself as an employee,
Yep.
and I take my CPP off my paycheck
Yep.
and submit it.
Yep.
So that $700 I'm submitting to the government every month,
Hmm.
I could take that and put in an investment.
Yeah. So it depends. Like if you're paying yourself up to the 85,000, the threshold.
Right,
Yeah.
Yeah.
So like you don't have to pay into CPP if you don't want to. Right. You don't have to. Right. I don't.
It's not a good investment. If
Sorry?
you look at what you get from the government after you retire, it's the lousiest investment ever. If you would have took that money and invested, you'd end up with way more money than what CPP's going to
Do you want to come up here? You want to come up here?
get. Well, that's the truth.
I know. I know.
So, I mean, I'm almost 60, so it doesn't benefit me, but the younger people
Correct.
that are getting into business,
Correct.
that would be a good thing. Like, I'm too close to dying that it would help. It would help.
No,
help me
it's
anymore,
so no
right?
that so he's got it. He's got a good point because I have a plumber client that's been paying into CPP his whole life, and he's just like, well, I heard this guy's your client and he's doing dividends. He's also 30 years younger than you and can make up for it. But it's like if you don't pay in a CPP, I think it's eventually like if you don't pay in it for about 8 years, then you'll start to decrease your CPP. So again, it's understanding your situation. I'm not telling anyone in the room to do salary or dividends. It's use the workbook, and then that way you can go to your accountant, right? And you can, have a better understanding of how you can pay yourself. And I have accountants. I work with accountants, and they agree with me. They're like, yeah, CPP, I don't think it's a good investment. And if you have disciplined clients that will reallocate it, yes, you're probably better off to, but you're not going to touch it though. It's just set it and forget it, right? Right? If you don't have a family, if you're not really too focused on that, we can always just set in a portfolio. If you want to set up your kids and your grandkids and you want to structure your portfolio to be more tax efficient, there's permanent insurance, there's all kinds of different techniques, there's IPPs, right? There's all kinds of, there's no one size fits all, right? Yeah.
After 8 years, you said it starts to decrease.
I believe so,
Is there a
yeah.
level that it stops decreasing? 'Cause, like, if we said,
Good question.
okay, 86 CTP, but you paid into it 15, 20, 25 years prior to being your own business,
Ooh,
do you
that's
lose
a
all
great
that?
question.
No,
I-
you're still gonna get it.
No,
It's
like
just
you'll
that
have
you don't get as
something.
much.
You will have something.
Okay.
It's you're not gonna like it's gonna
That
go
would
down
be
to zero.
frustrating, right? Like,
I know one of my mentors, he stopped paying in a CPP for like 30 years, and he still got like around $500 or something like that. Yeah, yeah. So, okay, there's one here.
I'm wondering.
There's one here for. There's a couple on Zoom here, so we'll tackle the ones on Zoom. Sorry there, Matt. So, how did you know you were ready to incorporate? Okay. Is that my kid? Yeah. Okay. How did you know that you were ready to incorporate? I knew that I was ready to incorporate because, again, every situation is different. At the time, we were going through COVID, we were going through a tough time, and I didn't need that much to live. So what I basically did is I essentially sold all my stuff and I moved back to my parents' place after like being on my own for about 10 years. So I didn't need much to live. So I paid myself just enough to live, knowing that I'm only going to pay 9% tax in Manitoba. Okay? So it's not about, make 150 grand a year and then incorporate. Okay, I'll argue that. I have argued that with accountants all the time, right? So it's based on your situation. If you're open for liability, there's one. Number two is how much you need to live. Because what if you only need $2,500 a month, like me when I first started? I was single, I didn't meet Emily yet, didn't have a kid, I have a mortgage, I had nothing, right? So it depends on your situation. Okay. How do you structure your own corporation? So I structure where, again, I just pay myself enough to live. This is just what I do. I pay myself just enough to live, and I'm doing only dividends. I take the money that I would have given to CPP, and I reallocate up to my holding company. This is just me. I'm not saying it's for everybody. I put in permanent life insurance. That's where I put my CPP. Because if you compare permanent life insurance compared to CPP, completely do two different things. And then I take my profits and I throw it in my stock portfolio. That's structured to be tax efficient.
Alan, you need to do a whole seminar on permanent life.
There's a booklet over there. Okay. Yeah, I was in a room where an accountant said, life insurance is only there to protect your family. And I said, it's also there to create tax-free wealth for business owners. Because think about it, there's only 4 areas that you can build your wealth and not get taxed. One's your tax-free savings account. The other is your primary residence. Government will tax you on that. The third one is the lottery. And the fourth one is permanent life insurance. Those are the only 4 vehicles that you can put your money in if you win the lottery and not get taxed. Okay? Okay. Those are the ones for Zoom. Any other? Yeah.
What about investments? I hear that a lot of rich people just keep taking their profits and buying more stuff, so they never have profits. So, but they keep accumulating assets with their profits, but they never have to pay tax on it. Like Donald Trump.
Well, that's the borrowing, right? So in the Income Tax Act,
Yeah.
you are allowed to borrow. So you're not using your money, you're using someone else's money like the banks. Okay? And in the Income Tax Act, if you borrow money, yes, you'll pay interest, like an interest rate, but you will not pay taxes. Okay? And eventually, You just keep taking out these tax-free loans, whether it's like, as an example, it's in the booklet, permanent life insurance. And then once you pass away, that will then pay off the debt, and the rest goes tax-free. It gets credit to the CDA, right?
Do you have to have it in like a certain account to be able to borrow against it, like TFSA or something, or like say you have like stocks in one spot, you have like TFSA investments, to be able to borrow against that and then take that money out, you have to have it in a certain spot.
In a certain spot, like if we're talking about borrowing,
Yeah, so like what he's talking about, borrowing
Like-
against it to acquire more.
I mean, as long as there's available equity, like people, they borrow against their house to go get more real estate properties, right? I don't know, like if it has to be a specific spot.
Is he referring to permanent life insurance?
Yeah, I don't. Whether it's if you are, whether it's structured personally or corporately, it doesn't matter how you're borrowing from it. Are you talking about permanent life insurance, or are
No,
you
so
talking
like I
about?
have like a share matching with
Yeah.
work.
Got.
So I'm just wondering, like, say down the road if I'm able to borrow against that in some way.
Ooh, that's above my pay grade, buddy. I'll be honest. I'll be the first one to say that I don't know.
No, like,
But honestly,
can't remember what's the
Good question for your lawyer, Alex.
yeah,
yeah.
Isaac, if you want, I can write that question down. I'll ask my accountant, and my lawyer for you. Okay. Any other questions? If you have to leave, by the way, like you gotta get home to your family, by all means. But I was also up at 2:30 this morning.
So you and
Because my kid was going off, and Emily just said, "Just have the hell with it." And we got on the road at 6, and it was.
We only got 20 years left.
Any other questions? That's it. Okay, I'll be sticking around. I'll be mingling. Please fill out the cue cards. Give me some feedback, and I don't know if we're gonna be going downstairs for some food or just staying up here and mingling. But thank you all for coming.